In my last video, we looked at Coca-Cola Company, and you can't really look at Coca-Cola without also looking at PepsiCo, stock ticker PEP, currently trading at $160.29. Over the last year, they are down roughly 1.5%. Year to date, they are down 10%. So it's looking pretty dim at the current time. You can see here in the last couple of days, just like Coca-Cola, they took quite a hit on the stock market. So it'll be interesting how it looks going into earnings season when it comes out tomorrow. Compared to the S&P 500, year to date, they are down 10%. As mentioned, S&P 500 up around 12%, Coca-Cola down 15%. Zooming out to 1 year, it's looking a little bit better. PepsiCo and Coca-Cola are trading side by side roughly, S&P 500 up around 15%. One small funny thing is if you zoom out even more, 5 years, you can see here PepsiCo had actually followed S&P 500 pretty closely, while Coca-Cola is only up 14%. Pepsi actually has some pretty good dividend statistics. You can see dividend yield 3.16%, annual payout just over $5, payout ratio just slightly above the 60% payout ratio I would like it to be at, 5-year growth rate of around 7%, and the dividend growth streak of 50 years, making them a dividend king. Which means that if we look at the dividend history, you can see that it's just how we want to see it, up and to the right. Coming up here, you can see indeed consecutive years of dividend payments, 50, and consecutive years of dividend growth, also 50. Pepsi is indeed a well-run company. As we jump into the financial statement, you can see the revenue has gone up from 64 billion to 90 billion in the last report. Coming down to the net income, it's looking a little bit worse, I would say. Had 12 billion back in 2018, then 777, 8.9 and back down to just under 8. So there isn't a lot of growth on the net income. And if you jump into the cash flow statement, you can see here basically cash from operations looking at 9.4, 9.6, 10, 11, 10, back down to 10 again. And the capital expenditures are rising quite a bit from 3.2 up to 5.2. So capital expenditures rising while the cash from operations remain relatively steady. That isn't really something we'd like to see because this means they don't produce as much free cash flow to pay the dividend and also to grow it in the future. Coming down into the bottom here, you can see free cash flow per share on the last report is actually just $4.16. If you remember from the dividend stats, the dividend was actually $5, which means they can't pay out the dividend just using free cash flow. Before we jump into the intrinsic value calculation, I do want to take a close look at what Wall Street thinks about Pepsi. And the current time, they are a buy at 3.5. So it is pretty close to a hold, as you can see here. I think 3.49, it would be rated as a hold. Analysts are a bit on the fence about it, while 10 have it as a hold. There's actually some on the sell side, while a few is on the buy side. 20 analysts covering in total. Coming down to the price target from the different analysts, you can see here, if you take the average price target, it's pretty high, 194, which could indicate a potential upside of 21%. But you can see here, it's a very high one by 220, while the low is at 156, so pretty close to the current price level. But jumping into our stock screener, zooming in a little bit more so we can see everything a little bit better, we do want to take a closer look at some of the key metrics. As you can see here, the PE ratio is under the 5-year average. Revenue is gone up 5% over the last year. They are pretty close to a 52-week low as well. Net debt to EBITDA is underneath the 3% ratio I would like it. And return on invested capital, return on equity also looking pretty good. Especially return on equity is pretty high, over 50%, while the 5-year average is closer to 60. Return on invested capital pretty close to the 5-year average. Margins are also looking pretty good. You can see gross margin of 70%. They have not been able to extend their growth for the operating margin, but profit margins are still looking pretty good. Obviously, we do want to see growth in the operating margin, but inflation and a lot of economic factors can push this obviously down. So this could potentially be transitory. And also jumping into a dividend data tab here, zooming in a little bit more, what we really want to see here is some steady growth. And you can see here, I mentioned earlier, they had roughly 7%. You can see a 5-year growth rate, 6.87, 10-year growth rate around 8%, but the last couple of years has actually been right around that 7% mark. Last time was 8.5, but other than that, it sits around 5 to 6%. Also looking pretty good. That's some steady growth, and we would like that to continue in the future. Coming down to the dividend yield graphs, you can see here could potentially be 8% discount, at least according to the dividend yield theory. On the right here, we do have a graph over the yield over the last 5 years. You can see it's actually followed that dividend yield theory pretty closely. There was some point here where it was pretty much a high value, very overvalued, and now we're coming just above the line, meaning it could be potentially undervalued at the current levels. But we do also have a lot of other valuation models. The first one being the discount cash flow. I don't want to go into every single one of them, so you can just pause the video whenever you feel like and see some of the estimations I have used. I think for this one, it's pretty bad actually, because they had a pretty bad year in terms of free cash flow last year. So I think the discount cash flow I don't want to use. Other than that, we do have the dividend discount model, the multiples valuation where we compare to other companies, Graham's revised valuation model, the PE model, free cash flow valuation, and also obviously the Peter Lynch model. Before we jump into the summary, thank you so much for watching. If you haven't done so already, please subscribe to the channel. Now let's jump into the summary where we do have all our valuation models. As mentioned earlier, I do want to exclude the discounted cash flow model because I think the small blip last time in the free cash flow from Pepsi is a bit of a mishap, so I don't think that will continue in the future. So I just want to have the rest of them. Also, we also want to apply a margin of safety because we do make some estimations. Over on the right here, we do have our margin of safety calculator. As you can see, we start with a standard of 25. Other than that, some of the key metrics here, we either add or deduct a little bit of margin of safety. As you can see here, maybe the payout ratio could be one you could potentially move out and just make it 0, so mean the margin of safety would be 10. So coming down here, the average intrinsic value is 147, meaning it is currently pretty fairly valued, with the current price being at 160. So if we put in a small margin of safety, let's just try the 15% first, meaning the acceptable buy price becomes 125. Using 10%, it becomes 132, and just removing margin of safety totally, as mentioned, the acceptable buy price is around 147, indicating that it is indeed fairly valued, maybe at the current time, at least according to some of these models, and also pretty close to the fair value or the intrinsic value of the stock based on our calculations. So for me personally, I think Pepsi is a very, very good company. There's no doubt about that at all. I think it is overvalued indeed, even though the analyst targets are much higher than the current levels. Can it reach those targets? Obviously it can. It is a great company, and as Warren Buffett famously said, we do want to invest in great companies even if we need to pay a little bit more. So if you are already a holder of Pepsi, I wouldn't sell at all. I might even add a little bit if you think it's a fair value, but starting a new position in Pepsi at the current time, maybe not the best time. Earnings is coming out right around the corner. Maybe there's a small pullback there if they don't actually meet estimations, so I would personally wait for that at least. Thank you so much for watching, and I'll be seeing you in the next video.